Hey everybody, how's it going? My name's Andy. My channel's Finding Value. If you like making money, or if you want to make more money, or if you want to have more knowledge on the market, subscribe, give me a thumbs up for the content. Today I'm going to go over a comment. The question in the comment section is, isn't it possible to have inflation in some parts of the economy and deflation in other parts? It seems to me that there's a massive opposing forces acting in the economy at the moment, some inflationary, some deflationary. At the moment, they are manifesting in different places. Anyway, I heard Harry Dent and MeetKevin say that in a crash, the only thing that doesn't go down is the 30-year Treasury bond. I'm interested. Do you have bonds? So the scenario that Harry Dent and MeetKevin are describing is a residential real estate collapse, where everything goes down, bonds go up because people run into bonds. They view bonds as a safe haven. Everyone runs into bonds, lowering interest rates, if that makes sense. So that scenario I am disagreeing with. I don't think that scenario is going to happen. And the reason I don't think that scenario is going to happen is because I don't see it in the markets. I'm going to show you some charts to show you what I see. And I don't think we have a housing market that's going to crash. So I think Harry Dent and I think MeetKevin are both wrong. It's as straightforward as I can get. And I think Harry Dent's been wrong for like the past 10 years. He's been predicting a crash for 10 years straight. He's like, oh, the crash is going to happen. In 2012 or 2013, he was like, the crash is going to happen in 2014. Then he revised it to 2015. Then he revised it to 2016. It's like, this dude thinks it's going to crash every single year. What he's missing, or at least my opinion of what I think he might be missing, and I don't know everything. I don't think he knows everything either. But I don't think they're tying in real estate, and I don't think they know how strong real estate really is. I mean, to make a claim that everything's going to crash is insane if you look at the data I'm going to show you. Now, I'm not going to show you real estate data. I've shown you that in other video clips. We are at all-time lows for inventory. All time. We have the best demographic ever coming to buy homes in home buying years. So, and then we've got days in the market, which is like all-time low as well. So how the hell are we going to have this blowout crash, which comes from real estate? And I've talked about the real estate cycle. And they have here that you should be going into bonds, which would be at the end of an expansionary phase of real estate, which we should see housing starts going out and peaking and coming back down, which we haven't even gone into an expansion phase, and we're 4 million homes short, 4 million home deficit in real estate right now, with the best demographic coming up, a large demographic in home buying years, ready to absolutely rip it. I mean, these guys are just wrong. Now, this is what I'm looking at, and I strongly disagree with a lot of their assessments. You're gonna lose me. I'll just go into this presentation. It's 3 slides. So this is the 10-year US Treasury yield. So a yield, when yields go up, it means that people are selling bonds. And typically, the thing that sparks yields to go up is inflation. Typically. So when you have inflation, what that does is it creates a real negative yield. And what a real negative yield is when your inflation rate is higher than your 10-year Treasury bond interest rate. So it becomes negative. So if the bond is paying, I'm going to make up numbers here, 1%. So if the bond's paying 1%, but your inflation is 2.5%, it's yielding a negative 1.5%. That bond is. And people sell it because they don't want to lose money. The selling of those bonds raises interest rates. And the reason that the government is doing quantitative easing is because they're trying to keep interest rates low. And what quantitative easing is doing is buying bonds to try to keep interest rates low. They're messing with the supply and demand of bonds, and they're creating demand for them. They're buying them and trying to suppress the rate down at certain rates. So the clearing mechanism of bonds is the interest rate. The higher the interest rate goes, the more demand for the bond. The problem is when interest rates go up, they crash existing bonds because the value of those go down if you can buy new bonds at a higher interest rate. So why would you keep your old bond? So what happens is the cash flows of the new bond at a higher interest rate has to equal those of the old bonds with lower interest rates. And in order for that to clear and be equal, one has to go drastically down in price to equal the same amount as a new bond that pays a higher interest rate. So hopefully that makes sense. So they're artificially holding down interest rates through quantitative easing by buying bonds to keep interest rates low. They're creating a fictitious demand at a lower interest rate to hold them down. They have to keep buying them and buying them. Now, you can see in this chart that the yields are going up. That means that existing bonds will go down. And let's see if that makes sense. This is TLT. This is the 20-year Treasury bond. And you can see they're breaking out to the downside. This is an uptrend here. This is another chart pattern. It broke to the downside, kind of did a back test, retest, and then it's heading on lower. So bonds, the prices of bonds are going down because yields are going up. People are selling their bonds. You're getting a rotation of money is what I call it. So they rotate out of bonds into other investments, whether that be stocks or it could potentially be commodities, gold, Bitcoin, whatever it is. They're going out of bonds into something else. It's the rotation of money. And inflation sparks that rotation of money. And when interest rates go higher, it's really going to spark the rotation of money. Because people are saying, I have this massive real negative yield. We have inflation. Then the interest rates start to come up because people start selling and rotating money, which then spurs more selling and more money, which then spurs selling in stocks as well when interest rates go up, because the interest rate is a risk-free return is what people call it. And if you can get a risk-free return at 4 or 5 or 6%, why would you be speculating on stocks which are priced to perfection through the roof because of the low interest rates? So the government, I should say the Federal Reserve, they buy bonds to keep interest rates low, to keep everything propped up. That's the whole reason of it. But bonds look like they broke to the downside and are heading lower, which is signaling a commodity boom, which is signaling inflation, which is signaling that we do not have worries about a stock market crash. Because if people were worried, and bonds are the collective, we'll call bond like the smart market. That's where you go to get your cues. Now, if bonds thought we were going to crash, we would see interest rates go down and bonds go up. We would see, so everyone would be piling into bonds, driving the interest rates down and driving the bond prices higher. We're seeing the exact opposite. So the market disagrees with Harry Dent and MeetKevin because of the data I'm showing you right here. This is a couple year long uptrend that was broken and another large chart pattern. This is probably going to fall quite a bit. That's my guess. Now, if that was the case, if people were scared, they would be running to bonds, which I just showed you they're not. Then they would be running to the dollar. So let's look at the dollar and the price of the dollar. This is a multi-year, this is about a decade-long chart pattern. Now, this was back during the other commodity boom down here. This was the top of the commodity boom in 2008. And you can see a declining dollar here. Then we went into a period where we had a housing or real estate crash. It was right here. That's why the dollar, everybody. Now, even if you went to here in 08, no, I don't have that. But 08, everybody ran into the dollar because of the crash in real estate. We had deflation. Now, we were coming up and the dollar was strengthening during this time period because we were in a recession, definitely a recession here in housing. And then we were in a recovery phase over here for housing. Right here, I would say we started going into and getting closer to an expansion phase, and eventually we broke out to the downside saying, hey, look, we're in an expansion phase of real estate. The dollar is weakening. We have inflation. And if the dollar's weakening, people are getting out of the dollar. We have more dollars in circulation. So this is more data saying that we have a commodity boom and that the dollar is weak. And when the dollar's weak, commodities go up. They have an inflation component in the commodity price. It's called gold. And we price everything against gold. So these guys, when they talk about inflation and deflation, they're talking about like the housing market tanking. I don't see it. I don't see it in the data that the market's telling me. At least not yet. So what I see is a very strong housing market, like really strong. Never been this strong style. All right. This is a bolita. A bolita is a cheetah and a bull mated together, and they created the housing market, which is strong like bull and fast like cheetah. That's a bolita. Now you've got something I think mixed up. You said that there's inflation in some areas and deflation. That's not the right mindset, in my opinion. The way that you want to look at it is that you have inflation or deflation. The way inflation, if you have more money in the system, that's all it is the aggregate kind of total money supply in that system. When that goes up, you have inflation. And when it goes down, you have deflation. There is no inflation, deflation in pockets. Those are just prices going up or down. That doesn't mean you have inflation or deflation. The way that people use it, I think, is incorrect. Inflation is just the expansion of the money supply. Done. We are expanding. Yes, the dollar's going down. Yields are going up. We're seeing all that. We're seeing the housing market go up in price. Bigger loans are going into homes. That is inflationary. That money's being created in the commercial banking system through the fractional reserve banking system. So when inflation comes, they go into certain sectors. And then what happens is money rotates from one sector to another sector. That's not inflation, but prices will go up, prices will go down, because this sector is drawing currency from other sectors. So when one sector goes up, it has to draw money from another sector where it has to go down equally, or from a group of sectors. Now, if you have money that's just piling into the system, which I propose, is going to push, it's going to push all sectors up. So you can't have all sectors go up at the same time and not have inflation. That is impossible. Because by definition, if you were to add them all up, you have a greater money supply. What I am proposing is that inflation's coming into the system, and the commodity sector will draw from all the other sectors' money to it. That's what I'm proposing. And that's where you're going to get your massive purchasing power gains. It's because commodities are going to go way up in relationship to all the other assets. It's drawing currency from all those other assets. It's drawing it from bonds. It's drawing it from stocks. It's drawing it from everywhere in that sector, in those sectors. Real estate will be drawing it in as well, along with the commodities. So that is my opinion. I don't think that they're right because I don't see the data in the market. I'm seeing large chart patterns break to the downside for the dollar, downside for bonds, and upside for yields. Right now, they are grossly wrong, and I don't see any data indicating that it's going to change in the real estate market, which is our leading indicator, and I don't see it in the demographics where the population is decreasing. I'm seeing the exact opposite. So I would take the opposite bet of them and invest in commodities, which I'm doing. And this is where we've got different viewpoints in the market. They think that bonds are going to go up, and you know what? You can have your bonds. I'm not going to touch them. If you guys like this content, subscribe to the channel. Give me a thumbs up. Thank you for listening. This is Finding Value.